Welcome back to the Dividend Diplomat YouTube channel, everyone. Lanny, Bert, who are we? The Dividend Diplomats. Everybody, we have a potentially undervalued dividend stock yielding over 3% and it's on the verge of becoming a dividend aristocrat. Buckle up. Let's go. Let's analyze a stock today, everybody.
Guys, before we do, make sure you guys smash that subscribe button, give Bert the Heart and Lanny a nice thumbs up because we're trying to reach the millions and millions of investors out there. Bert, let's hear you talk about this company that has increased their dividend for almost 20 years. Let's go.
That's right, everybody. We're going to get right into it. We're not going to mess around. We're not going to make you wait 30 minutes to hear this company. We're talking today about Texas Instruments. Texas Instruments, ticker symbol TXN. This company has been hot on my radar of late because everybody who's known, everyone who's watched our purchase videos over the last few months knows that I initiated a position in Texas Instruments. I want to get to 20 shares before the end of the year, and they are in the top spot right now, the top contender to replace Johnson & Johnson on my weekly dividend stock purchase. It was big. They just released earnings this week. So we're going to take a look at that earnings release and run them through some old algorithm here to tell us if it's an undervalued dividend stock to buy. Lanny, you want to tell us how we're going to do that?
First, they're the #1 contender because they won the Royal Rumble.
They did.
On that road to WrestleMania, guys. So, but those three dividend metrics: one, the price to earnings ratio less than the S&P 500; two, that dividend payout ratio, preferably between 40 and 60%, but definitely we look for less than 60%. And third, that history of growth, that growing that dividend income stream, guys. And there's no question on this dividend stock about that. Why do you need a company that grows that dividend? Because, guys, we're all trying to get to financial freedom. We want to buy assets to produce passive income that grows without you having to do anything except owning the stock. Come on, let's go.
And look, the growth is important. We are in a high inflation environment. If your income stream rate remains stagnant, it doesn't grow, you're actually losing value on that income stream. So it is critical, it is important that our dividend income stream continues to grow so it does not lose purchasing power over time due to inflation.
There it is, Bert, guys. So you're talking about the stock. You've been buying shares of the stock. You're almost at 100 shares of Johnson & Johnson stock. So you're looking to replace it. This is the #1 contender. Why is it on there? How did their earnings release look?
Well, it was actually fascinating for their earnings release. We're going to put the chart up here of Texas Instruments week. They released earnings. The results came out on Wednesday and the stock price dropped. You look at it here, it dropped from, it was 162 before earnings and it dropped $10 per share to 152 earnings. But guess what? We're right back up at the end of the week where it started, 161.36 at the end of the week. I guess when people had time to dissect the news, Lanny, and check out the broader market environment, the news must not have been that bad. So what happened? They talked about some of the things that are plaguing Intel, AMD, and many of the other companies in that semiconductor business. They're getting hit by slowing demand for personal devices and weakening just demand across the sector as a whole. We know that's plagued some of the other players. Of course, it's going to hit Texas Instruments too. That said, though, the earnings still looked great. They had a revenue of $5.2 billion during the quarter, which is a 1% increase from the previous quarter and 13% increase from the same quarter in the previous year. Net income, $2.2 billion. That was an 18% increase compared to the year before. Earnings per share, $2.47 per share, increase 19% compared to the same year period. So on the income statement, on the face of that income statement, that beautiful income statement where we're looking at it every quarter to see the results, they looked fantastic.
That's what I love to hear, guys. I mean, right now, earnings are up, revenue is up. The only thing that they keep being concerned about right now is that cash flow, right?
Yeah, that's right. So that is the one thing that kind of jumped out here. Their cash flow from operations, it was still solid at 2.7 billion during the quarter. Free cash flow, 2 billion. That said, they also measured and they throw into their earnings release a chart that we're going to put up on the screen as well. They look at their trailing 12 months cash flow, still great. Free cash flow, though, dropped in the trailing 12-month period from the same time last year from 7.1 billion to 5.9 billion. So free cash flow as a percent of revenue over that time, over the trailing 12 months, as of September 30th, 2021 was 40.6%. This year, you bring it forward 29.3%. So you can see where that demand is squeezing a little bit here, and costs are rising.
No, exactly. Man, the metrics. So you're saying the stock price fell. Right now the stock price is down 15+% year to date. A little bit less than what the S&P 500 is down, which is close to 19% out of that bear market, 20% territory. The Texas Instruments, man, what a great company. I can't wait to run them through the Dividend Diplomat stock screener at the current price of $161.36. Bert, you want to kick us off with that first dividend stock metric?
You got it. 161.36 was the price as of October 28th when the market closed. Forward EPS, $8.09. That gives you a PE ratio of 19.95. So the PE ratio is climbing a little bit from where it was a month ago. And that has to do with the fact that in that earnings release, they slashed earnings guidance just a little bit here. There's a little trim down of what they're expecting forward earnings per share over the next year. So as a result, drop down, but that PE ratio, even after that haircut that everyone's expecting, is still in line with the S&P 500 today. It's just not as much of a discount as it was before.
Hey, still solid, because when we get to that dividend payout ratio, that second metric, currently pay on annual $4.96, taking that over the $8.09. Whoa, Texas Instruments actually above 60%, 61.3%. Bart, what's going on there?
So, I mean, it's the same thing we're talking about. Earnings come down, payout ratio is going to go up a little bit. So that's really the story here.
Still safe, but maybe dividend growth is going to slow tremendously over the next 2 to 3 years, possibly.
I think that's astute, because when we move into that third metric here, the dividend growth rate, their 5-year dividend growth rate is 18.67%. And they just increased that dividend about 8%. I do not expect them to return anywhere close to that double-digit percent increase because of all the trends that you just highlighted, Lanny, and the fact that cash flow is getting squeezed a little bit. It's going to be much lower dividend growth over the next few years, I'm sure.
But again, growing the dividend nonstop for 19 years. They'll make it 20 for sure next year. There's no question about that, guys. But yeah, we probably will see the mid digits maybe going forward for the next couple of years, possibly.
Yep, that sounds about right. And then we'll move into that bonus metric, the dividend yield, 3.07% today. Still hitting above that 3% mark, double the S&P 500, and still above those high yield savings accounts.
A $146 billion market cap company, $161 share price. J&J, I know, is always between the 160, 175. Is this the catalyst to start fueling your passive income journey after J&J?
We'll find out. Let me summarize here. PE ratio 19.95, payout 61, 5-year dividend growth rate 18, increase that dividend for 19 years, yield 3%. You asked a very great question, Lanny. I'm still looking at them, but to be honest with you, we got to keep an eye on them, because I might not commit to purchasing them for a year and a half like I did Johnson & Johnson, especially if the metrics are looking like this. That said, though, it's still a great company. It's still one of the best in the sector. They're trading at a higher multiple than Intel and AMD, probably for good reason. Sometimes the better companies are just more expensive. That's typically how this process works.
High quality.
Yeah, I still want to get to 20 shares, and I'm still considering them to replace that Johnson & Johnson. But UPS, which we talked about in our last video, Lanny, is also throwing their hat into the ring and saying, hey, look at me, buy me right now. Screw Texas Instruments. Yeah, so it's an interesting one. What are your thoughts about Texas Instruments, Lanny?
Yeah, I think they're a great company. You kind of throw them in there with the higher quality, always trading at a higher multiple type of company, type of business there. Going through some headwinds. They're going through some pain. Every company goes through it. Coke's gone through it. Procter & Gamble's gone through it. Intel, Texas Instruments currently going through it. Scott's currently going through it. Stanley Black & Decker is going through it. I mean, always take some learning points of the why they're going through it. Are they able to pass on price to the consumer? Are they, somehow able to find new markets to deliver goods to? So, I mean, there's some learning points to all these companies that go through pain.
Yep. No, I think thank you for adding that. It's good. We'll find out, though. And that's why we look at companies that have increased their dividend for decades. upon decades because they've still managed through those good and bad economic cycles to continue growing earnings and growing that dividend, a sign of long-term stability and hopefully earning a spot in your portfolio. So let us know, what do you think about Texas Instrument? Are you a fan after their latest earnings release? If you were me, would you use Texas Instrument instead of Johnson & Johnson when I reach that 100 share of Johnson & Johnson mark? Or would you move to UPS or a different dividend stock instead? Let me know down there. Look down there, everyone. Come on, let's go.
If you haven't already, make sure to subscribe to the channel. Definitely give this video a thumbs up, as we're all trying to help each other find investment opportunities to put our cash to work, because we all know cash sitting in the bank, cash sitting on the sidelines is doing nothing for you. Got to buy those assets, baby.
Let's do it. So everyone, keep growing that income, keep growing that passive income stream. Lanny, let's send these suckers out of here.
That was Bert the Hurt and Lanny from the Dividend Diplomats, over and out.